Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss updates to the Biden tax plan as it makes its way through Congress. Most of the changes target the top 1% of income earners. For example, there's talk of increases to income taxes, capital gains taxes, corporate taxes, and even estate taxes. But will any of this even make a dent in the pockets of billionaires? While Biden is trying to target income inequality, his plan does little to address wealth inequality. So Trishul outlines one radical idea that could change everything. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So back in March, we talked about one of the Biden tax proposals and some of the ideas that Democrats and Biden wanted to implement to try to address income inequality. And we now have a version that's working its way through Congress with some specifics. And we're going to start talking about this. And one of the kind of key things is, I guess, the theme that came out both from our past conversation and from looking through these details was that they actually really are trying to target income inequality. And so there'll be a few ways that they're trying to do this. We're going to kind of go over some of the details, some of the bigger picture philosophies, at least our takes on it. But Trisha, what was your first take when you started reading some of the details? Either a quick key observation or a big theme that you want to make sure that our listeners are really aware of?
Yeah, so I think you did touch on an important aspect of the plan, and that's the notion that income inequality is something that's probably top of mind in all of these conversations or all of these different snippets that we're getting about the plan. And from that perspective, I probably want to relate two things. We've talked a lot about income inequality over these conversations, and we've actually had a couple of episodes on that specific topic. But the high level notion is, for basically the past generation, the bottom probably 60% of income earners, after you adjust for inflation, have seen their real incomes go either flat or go down. And then the next 20% above that has maybe seen a marginal increase. But basically, the farther up you go, you've seen a pretty large explosion in incomes relative to what they used to be. So, the top 1% is earning far more than the top 1% a generation ago, and the top 0.1% is earning far, far more, and the top 0.001% is earning far, far, far more than they used to a generation ago. And the end concern about all this is we've seen a big shift in the overall earning potential of these different classes. So when you look at median averages, it looks like maybe the average income earner has been about flat over the last generation from then until now, but it's highly skewed, meaning the rich have done, or the high income earners have gotten much better at earning income, and everybody else, or the majority, has gotten worse. So making it look like the median is slightly better.
I'm actually now that I think about it, you mentioned that. Is there anything that would affect median median household incomes at all? I'm trying to remember if any of the details would actually come into play there.
Yeah, so as part of this package that's making its way, now there's only tidbits. There's not a full package. It's not really set in stone. It's more like a menu of things that the Democrats want to get through. And frankly, any and all of them are likely on the chopping block. So, but yeah, pretty much all of the legislation is targeting high income earners. meaning the medium income earner will not be impacted with higher taxes for the vast majority of these changes. There may be edge cases on the fringe, but it's hard to see how that might play out for the medium income earners. Frankly, we'll go through some of the bullet points in more detail, and we'll kind of see how each of them is mainly targeted high income earners. So that's the high level thing that I wanted to point out, that yeah, it did make clear to me that it was targeting high income earners. However, I want to put a big star or caveat next to that, saying, well, that income inequality, as we've also discussed over a handful of episodes, is part of the equation, but there's a big part of the equation that represents wealth inequality. So there's income, what you earn every year, and there's wealth, how much you have overall. And over the last generation, we've seen a similar trend where wealth has started to concentrate more and more at the top end of wealthy individuals, meaning those individuals that control the top 10% of wealth can control more than the bottom 90%, something like that. And that's only getting worse, meaning soon it'll be the top 5% control more than the top whatever, and soon it'll be even worse than that. And
Yeah. Go ahead.
that exacerbation is maybe touched upon in this plan, and we'll talk about why that may not actually be impacted too much by these proposals.
Yeah, so I do a quick scan of my notes and a couple other things. It looks like the child tax credit, the expanded child tax credit has been extended. So I think that would probably the only thing that would really affect any of those kind of median household incomes. Where
Right,
again,
and
it's
that'll
fully
help
refundable, it's
median.
bigger.
Right.
Yeah. I think everything else looks like it's targeting incomes 400K and above. This is like almost came down to like the campaign promise. Like he's so dogmatically sticking to that number. Now again, last time we pulled up the income percentile calculator. 400,000 household income is the top 1% of incomes. It's like he really is going after that top 1% of income. But
Right.
again, he's not necessarily targeting the top 1% of wealth. But
Right.
let's start going through some of those details. So that 400K number is going to come up a lot, but some of the details, like the top tax bracket, is going back up to 39.6%. I think this almost feels like it's uh, like a politically easy move where they could have gone to 40 or 41%. Like they could have chosen a different number, but because they went back to the way it was before, it just feels like it's undoing the Trump tax cut. But it is going back up to 39.6. It's going to apply to households with income for individuals over 400,000, married filing jointly of 450,000. Long-term capital gains rates go up to 25%. On those incomes over, same thing, 400,000, single, 450, married filing jointly. And the two things I think about there are it's one, like the difference between 400 and 450, like this feels unusual, where usually married filing jointly is noticeably more than the single, and this actually might be bringing into a pretty big marriage penalty, where if you had two people, say husband and wife, they both earned something like 200 or 250, which is unusual in itself, but that's a realistic possibility. They're paying significantly more in taxes because they are both combining to get over that 450 number and paying up to 500K income than someone who was their, can say, their coworker who's single and is only earning that same 250. Now again, like that's, I don't say only, but I'm trying to kind of be cognizant of that. But it does create this pretty big marriage penalty in terms of income, where they could be paying an additional 4%, of income taxes compared to someone else who sits right next to them, does the same job. And I, I guess I'm not necessarily concerned about the numbers specifically, because again, these are all households in the top 1%. I think that's part of what I think of the challenge. Like, if I look at some of these and like, oh, that doesn't. I feel like there's a better way to do this. It runs the risk of almost sounding obtuse of like, oh, it's only affecting the top 1% anyways, and so it's affecting this top 1% instead of this other top 1%. And so I want to make that like a huge caveat in our conversation, is that these are all kind of households that are fortunate enough to be in the top 1% already. And so from that perspective, yes, it is trying to address income inequality. Again, we'll talk about wealth inequality separately, but now we're kind of like, compared to the way it was under the current tax law, the way it was prior to the Tax Cut of Jobs Act, or we have some other basis of comparison. That's why I say like this kind of marriage penalty thing does seem a little unusual. I would have expected the single number, if it's at 400, that the married filing jointly number would have been a little higher. Or if married filing jointly is at 450, the single number would have been actually a little bit lower. That's one of the things that does feel a little unusual.
Right. Maybe another way to think about this is, yeah, typically the married filing jointly tax bracket is, ballpark double whatever the single is in terms of income. So, at the 12% range, you can earn up to 40,000 if you're single and about 80,000 if you're married. At the 22% range currently, you can earn about 86,000 if you're single, or like 170,000 and change if you're married, and so on. And that kind of stays true. There's no real penalty, in air quotes, for being married until you get to these top tier brackets. And then, yeah, there's a big difference. For example, currently in the 35% tax bracket, if you're single, you can earn up to 523,000. However, if you're married, you can't earn over $1 million. No, you're going to jump to the next bracket the moment you're above 628,000. So there is already this notion of a penalty if you're married in these higher tax brackets. So the new Biden tax plan will, make that penalty even more obvious for households closer to 400,000 and above. And I get, two things go through my mind. One is, well, could those married families just do, married but filing separately, and then wouldn't that obviate some of these concerns?
I don't think so. Because we haven't seen what the rates would look like for married filing separately. I haven't seen anyone that talks about those numbers. And so you know what? Actually, I want to pull up what's the current married filing jointly versus married filing single or separately versus married filing separately, because there's usually is a penalty for the married filing separately. Let's see, where did I just had this. So let's take a look at so to go from married filing jointly, say the 24% tax bracket's 171 to 326. The married filing separately, it is I think it's exactly half. Oh, I guess so. Maybe that wasn't the case in the past, but it looks like maybe under the Tax Cut and Jobs Act they might have fixed that part, because it does look like. Okay, so that isn't kind of an update that looks like they're keeping. Well, it does look like the single filer brackets and rates are right in line with the married filing separately brackets and rates.
Right.
I think except at that top tax bracket. Yeah, so everything under the bottom, everything except the top tax bracket looks like it's about the same. But but the top tax bracket, so currently 37% for a single filer, 30% on 518 or more. Married filing jointly, 37% of 622 or more. Married filing separately, 37% of 311. So currently, the married filing separately is exactly half of married filing jointly, but that's much lower than the single. So currently, if you had a household where, say, both husband and wife were making 300,000 each, they would both be. No, so you probably needs to be a little bit more than that, I think, because I need to be in. So if they're both making 500,000 each, I guess, maybe 400.
Right.
So
Yeah.
they'd have, yeah. So yeah, if they both made 500 and they were single, they would not be in the top tax bracket. If they both made 500 and they do married filing separately, they're both in the top tax bracket by about $190,000. That's an example. If they both made 500,
Right.
then there is a huge married penalty, and married filing separately does not solve that.
Right. If
So
you're above 600,000 ish in
correct, yeah.
combined household income.
And so
Yeah.
this actually just kind of, so my current guess is that if it's going to be married filing jointly, at 450, at married filing separately, it'll probably be 225 each. So that there'll be a 100 to, yeah, it was something like that, 175K each of taxable income in that top tax bracket. Now again, it's like it'd be going from 35 to 39.6, but on 100K, the tax penalty I guess it could be as much if there's like a 5% difference, trying to do the math in my head, and it's about 150 each, so it's 300K income maybe. You can see the marriage penalty being on the scale of $15,000.
Now, couldn't you file as a head of household and then have the spouse be married filing separately?
Uh, I'm not a CPA. um, uh, I want to say, I don't know if you can if you're married. If you're actually married, then I don't think you can. And I think if you are not married, you need to have kids, but um, there's also, like, you lose certain deductions and um, uh, exemptions if you are head of household versus single. So like a good CPA will kind of do all these calculations for you, kind of based on, you live together, do you have kids, are you actually married or not married? Because there's a lot of
Right.
other legal protections that marriage provide. They can kind of help figure this out.
Oh, so head of household, it looks like you have to be unmarried.
Yeah, I believe that's right. But also, I do know, even if you had a couple together, they um the they're living together, they have kids. I do know that even if they're not married, they can't both claim head of household. Like
Yeah,
that's something I
for
do
sure.
know. Like, you can't have two head of households, even if they have multiple kids, even if they're from different marriages. Um, if they have the same address and they're living together, they can't claim head of household. They can't
Right.
both.
That's true too.
So you'd get like this one, like one would claim head of household and also include all of the kids, because the single wouldn't be able to get any benefits from the exemptions related to kids that the head of household gets.
Right.
So yeah, this tax law is fun.
But
Okay.
I think the quick and dirty is the marriage penalty. If it does stay as we, or does get exacerbated as we expect, it'll only affect the 400,000 and above
Correct.
income or
Yes.
households. Yep.
Yes. Uh, so yeah, um, it would be mostly affecting uh income. So it'd be incomes that would uh be in the second to top bracket if they're single, but in the top bracket if they're married. So currently, like again, it's like if both husband and wife earn 225 or more. Um, I think very roughly, if they're single, they'd be in the 35% tax bracket. So yeah, it would be incomes between 225 and 400. I think
Right.
that's where that penalty exists. So again, I guess I think that might be my issue with well, I don't know how like, truly quantify that because I would say incomes of 225 aren't necessarily top 1%, but again, if they are living together, I guess the marriage, yeah, if they both make over 225, then yeah, they're back. The household income percentile calculator is back in that 1%. So yeah, so the marriage penalty is there, but it does only affect the top 1%.
Right.
Okay, so moving on. What was another detail that you saw that was you want to make sure we kind of talk about today?
So another one that might affect, around this demographic, 400,000 ish is, or even less, is the mega backdoor Roth might be getting the axe.
Yeah, so you want to explain that real quick? But both regular
Right.
backdoor Roth and mega backdoor Roth.
Right. So the backdoor Roth is a strategy that it was a quasi loophole, but eventually given the okay by the IRS. And the notion is if you were above certain income limits under certain conditions, you weren't able to make a contribution to your Roth IRA, but there was a way to do it by making a non deductible traditional IRA contribution and then doing a Roth conversion with that amount into the Roth. We did a whole episode on it. There's plenty of details in that episode, but the notion is you could get past those income limits by following this procedure, effectively making the Roth contribution possible even if you're above the income limits. And the strategy was known as the mega backdoor Roth. And essentially, what would be happening here is this type of strategy would no longer be possible given the extra wordings that might be placed into the legislation that would kind of cut off this, this potential loophole from happening.
Yeah, so it looks like if it's passed as is, you could still do it this year, 2021, but it'll be gone in 2022. And it looks like it is applying to both the regular backdoor Roth that you have an IRA at any financial institution, any custodian, and the mega backdoor Roth, which should be done as through employer plans. And it's like this is one of those things like some plans have been doing this for a while, but just felt like in just the last year or two, a lot more 401k plans were offering this as kind of like consistently enough that I was making sure to look for it for all my clients. And so like we only got a few years of enough companies introducing it, and now all the HR departments and all the 401k plans are to be rewritten and kind of go back and undo that.
Right.
But
So, this actually might affect individuals who are not necessarily in the top 1% of income earners. For example, the backdoor Roth strategy was sensible for married filing jointly households with incomes above 208,000. And if you're single, above 140,000. So, frankly, this might be one area where your less than one percenters might be affected.
you know what? Actually, now that I think about that, I think this is going to be really confusing. It looks like the prohibition will only be for those high incomes, which would be the single of 400, joint of 450. I think the mega backdoor Roth and backdoor Roth will still exist for income earners below that.
I've heard it
Does
go
that
both ways.
okay?
So I think it's up in the air, but so yeah, it could be that these prohibitions or these legislative changes might only apply to the 1%, but I think it's not necessarily clear,
Well,
and
that's
of
going to
course
be
subject to
really
change.
interesting for employers to try and figure out, especially like, okay, you earn 300,000, you can do the mega backdoor Roth in the plan, but if your spouse earns 200,000, then you can't, or I don't know. That's just gonna be a huge logistical nightmare, um, because there's already kind of hard challenges for employer-based plans trying to account for employee spouses who aren't employees. Um, the say the current guess is um, the any Roth contributions or Roth conversions. So that's technically back to Roth. It's a non-deductible after-tax contribution that you're doing a Roth conversion. The Roth conversions, that amount being converted will add to your taxable income to kind of that could push you over the limits, whereas you may not have been there before. So if your income's is under the limit, and you are doing this kind of backdoor Roth strategy, it should be okay because that was coming from your taxable income this year anyways, but you wouldn't necessarily be able to do extra Roth conversions. That's gonna if you can do it up to the limit versus if it's eliminated completely. But again, I'm not quite sure how. So if a 401k plan allows you to do the mega backdoor Roth, and then either your income goes up later in the year, maybe you get a big bonus, you get a raise, or sell stock that pushes your total income over that number, or the 401k plan doesn't know what your spouse earns, so you end up going over those numbers. I don't know if there's a plan in place or a law or a detail that allows you to do a recharacterization of a Roth conversion. So like if you accidentally do too much backdoor Roth earlier in the year, even though because you're planning on your income wasn't going to be high enough, but then your income does end up higher, I don't know how that will be unwound. That'll be kind of one of the things we need to figure out.
Yeah, I mean, I think depending on which way this goes, it will open up lots of possibilities for missteps all along the way. So, as we said before, it'll certainly keep tax professionals busy, and it'll certainly keep advisors busy. But the high level notion is, yeah, the mega backdoor Roth allowed an extra 6,000 per individual or 12,000 per family to get that much more contributions than they would otherwise, and that might be going away for certain individuals. And the mega backdoor Roth allowed individuals to potentially shelter up to 58,000 a year in total, whereas without it, you might be capped around 19,500 plus whatever your employer matches. So, that going away might also be pretty impactful for those that are currently able to do that.
Yeah, I think the other thing that looks like it could come into play is there might be a 10-year window where after 10 years they may ban Roth conversions completely if your income is over, again, that 400, 450 number. And here, so like currently you can do Roth conversions of after-tax dollars. So it looks like that's what they're trying to eliminate now. But even if you're over the income, you can do Roth conversions of pre-tax dollars, like just a regular Roth conversion. And it looks like they still want to allow that because this is all money that high income earners will be putting in pre-tax. It is encouraging them to make it taxable now and convert it to a Roth within that window. So there's currently proposed a 10-year window for that. So you might still get the Roth conversions of pre-tax dollars, but now the math starts to change. Whereas the Roth conversions of after-tax dollars just kind of made so much sense because it was basically a non-taxable event for the taxpayer. It's just a logistic and kind of accounting form of making a change from after tax to Roth was not a taxable event; it just had to follow the tax laws. So maybe that's what I'm thinking of is the conversions of after tax amounts might be eliminated regardless of income, if that sounds right. But after 10 years, all Roth conversions will be prohibited for the high income taxpayers. Does that sound right?
Yeah, again, a big maybe, or potentially, but it perhaps that might
Okay.
end up being how it comes. Yeah. Well, to also tie this in though, there's other changes to IRAs, and a big one for some people is the notion that there may be caps on the size that these accounts can get to. Something we talked about way back is you could run into situations where an individual ends up with millions and potentially tens of millions in these tax shelters. And we mentioned it in the context of the Romney IRA, the notion that Mitt Romney, this came out during his presidential run, was able to get over 100 million or so into his IRA account, which had a lot of people scratching their heads because if you can only put in, like 6,000 a year or so, how do you get that much money in there? And turns out there's ways to do it. You can check out that episode for more. But, it also came up more recently with Peter Thiel, another wealthy individual who was also able to get a pretty silly amount into his IRA, following the stuff you're allowed to do. But I believe one source cited his Roth IRA with like $5 billion or something like that.
Yeah, it's something like he turned a small investment in a private company, I think this was PayPal at the time, into $25 million in his Roth IRA, which kind of felt like Mitt Romney, like, oh, this is closer to normal. Like we've seen other examples. And then he reinvested those proceeds in another private company. I think it was mostly Tesla. I'm not 100% sure about that. And like the 25 million then turned into 5 billion.
Right. And then, this had a lot of alarms going off because this money is effectively sheltered, meaning if it's Roth money, then it will never be taxed. And even if it's IRA money, it will be deferred indefinitely until, likely after he passes away. And the concern here is that if it's not taxed and it keeps growing, that's a pretty large benefit. Again, this was meant to benefit income earners to help them save for retirement, not necessarily meant to provide billions of dollars in shelters. So the proposed change would lower or put a cap on how much you can keep in these types of accounts. Something around like 10 million, for example. That's a number I've heard, meaning if your account grows to that much, you'd be required to take a minimum distribution to bring your account back to that size, meaning it can't grow to, billions of dollars or even tens of billions. Once it gets above, let's say 10 million, then you got to trim it back.
Yeah, I think the numbers are if you have over 10 million, it'll be a 50% RMD. You have to take the money out. It has to take half of what's out. And if it's over 20 million, you have to take it all out. You cannot kind of have a Roth IRA over $20 million.
Right. You have to take it all out. That's above that cutoff.
Yeah.
Right.
So I think one kind of, I want to say caveat was like, if you, don't want you to feel bad for Peter Thiel here. When he takes 5, or let's see, what is it, 4.98 million, 4.98 billion. Did I do that right? Or did I miss? Is it 4.98 billion out of his Roth IRA? It's in a Roth IRA. It's not actually a taxable RMD like you think of with your traditional 401k, traditional IRA. He has to take the money out. He'll still reinvest it in some other taxable investment account or other private equity, whatever he wants to invest in. So he's not having to pay a $5 billion income tax bill. It's still coming out of the Roth as a tax-free distribution. He just has to take it out and invest it somewhere outside of the Roth, where you start to get into estate planning. You know what? He'll probably invest in something. It'll keep growing, get a stuff from basis, and his kids don't pay taxes on it anyways. Now that I say
Right.
it
Yeah.
out loud.
So, or family foundation. You get the point.
Yeah. The $5 billion still doesn't get taxed because they'll do something else that avoids taxes.
Right. So Biden said when he started this legislative process, he kind of put out snippets in the news, and part of what he was saying is he wants billionaires to pay their fair share, and he's been quoted as saying, America's billionaires pay an average income tax rate of 8.2%. So what he's trying to say is billionaires, when they earn income, they pay a pretty low percent compared to the average income earner. And perhaps, it's through some of these different means that they're able to pull this off.
Yeah, one, I wasn't quite sure where he caught the number, although it would not surprise me he's taking like the ProPublica analysis and kind of applying it to more billionaires, and they had a limited sample size. Also, it gets back to that, like, well, if that's their true income tax rate, like, that number feels too low. But if he's applying that number to other like wealth gained, something like that, then yes, that sounds closer. But yeah, it was one of those things, like the campaign promise of going after billionaires. It went after the 1% income earners, but there there wasn't a lot that really seemed to target the wealth. And one thing, so there's two things. One was a small technical detail. Defective grantor trusts were eliminated. This is a estate planning strategy that kind of allows you to put money into something like these trusts. It's called an intentionally defective grantor trust. And so you're transferring money out of your estate. You still have some control, and you can receive income from these trusts, so you can still use it to support lifestyle. But then the estate continues to grow in this trust until you pass away, and then any growth kind of isn't part of your estate, so there's no estate taxes on the growth. It's also used in paying premiums on life insurance, so you start to get an amplification or leverage benefit of, okay, if this asset can pay $100,000 per year of a life insurance premium, that will pay a $10 million death benefit when you pass away, which can start to pay either some of the estate taxes or can also be left for heirs. But this might be going away. The other thing was the reduction in the unified creditor amount. So it's up to like 11 million plus, kind of, because this is one of those things IRS does a pretty good job of adjusting with inflation sometimes. They do an okay job sometimes. It was 10 million, came up to up a little over $11 million now. So a married couple could exclude 23 million from their estate for estate tax purposes. That might be coming back down to 5 or 6 million. So it's kind of cut in half. So again, it's if your estate is over $22 million, then and they've just removing this one defective grantor trust and reducing the estate tax exemption. This could be a pretty big tax for wealthy on estate transfers, but looks like they kept the step up in basis, so that still exists. So there's not necessarily any extra income tax upon death, but again, kind of targeting this. This is an okay one. Like this actually felt like if you're trying to target um, wealth inequality, at the very least, you're kind of doing it on a generational basis. Like again, Peter Thiel, like we might be able to have some of that wealth taxed upon his death, but he's like still wouldn't have to pay the income taxes on the gain if he uses stuff on basis. Was there anything else that you
Right.
saw
So
that
yeah.
does kind of address the wealth inequality side?
Well, I'd say the estate tax, lowering that exemption amount from married 23 million down to like 11 million will likely have some impact if you're in that 11 to 23 million range. So yeah, certainly that there's plenty of wealth in that region, but if you're above that range, it won't make that big of a difference, or it'll hardly be noticeable to the billionaires.
That's great. That's a great point.
There,
Yeah, it's one of those like marginal differences. So if your combined estate goes from 1 billion to 1.01 billion, and then you're paying 50, it is like 50% of taxes on that. You're paying a 0.5% more in estate tax for a billionaire. Like
right, yeah, and
yeah,
that's
like
assuming you're actually paying that tax and not
yeah,
doing something else.
yeah.
So, but yeah, that so it'll affect some wealthy individuals, but not likely. It might affect the top 1%, but not like the top 0.1% and above. Something like that. There's also a change in, or a potential change in, the capital gains tax rates. So now it's capped at 20%, and soon the proposal is that it might go to 25%. So that might give it a little bit more bite, I think, perhaps. But again, it may not make so much of a difference to billionaires, but it may make sense to the 400,000 plus income earners.
Yeah, yeah. I think there's also a few things on the net investment tax, net investment income tax. So this is the 3.8% Obamacare surtax. It looks like that would also add to the long-term capital gains. So if they have long-term capital gains and incomes over 400/450, their max rate would be like 28.6% federal. Then you have state on top of that. They're also adding the net investment income tax to high income S corp owners. So previously with an S corp, you would be able to separate kind of S corp income into employee income or employee salaries, which do have FICA taxes and other employment taxes, from owner dividends, which did not have those payroll taxes and previously did not have any of the net investment income tax. So they're adding net investment income tax to S corps, and that 3.8%. I think it's over 400 and 450 with some phase out or phase in ranges. So again, targeting those high incomes, they're trying to say like wherever this high income comes from, we're trying to increase the taxes on it, whether it's the S corp, whether it's coming from capital gains. Like anything over 400, they're really trying to target to increase the tax rate on those higher incomes.
Right. So, I think those are the main things that kind of target incomes. However, I think the big thing that's kind of missing is, well, what's the actual impact to wealth inequality?
Yeah, it's I almost wonder if we can pull up. Well, maybe I'll look at it later. But the ProPublica talks about what were the actual incomes that they claimed on their income taxes for some of these really wealthy. Because I know they one of the things they added a 3% surtax on incomes over $5 million. It's like they're trying like whatever some really really high income number is, they're adding another 3% on that. So like the true top tax rate is actually 42.6% for ordinary income. But again, that's a $5 million mark, and it's again trying to target those really high incomes. But again, it's like we're talking about this is all income taxes, and like you said, what is some of the how does this address some of the inequality concerns?
Right. So, what we kind of learned from that episode is there's this notion of a true tax rate where you look at not necessarily the taxes paid on the dollar of income earned, but the taxes paid on a dollar of wealth generated. So, for example, for the average household, for them to generate an extra $100,000 in wealth, in net worth, they would have to pay over, based on these numbers, over $100,000 in taxes. That's quite a bit. And they said, okay, well, how much in taxes do the wealthy have to pay to increase their wealth by $100,000? And it turns out it's far less. So based on some of the numbers, for example, for Warren Buffett, he would pay $100.
They,
Well, okay. So there's a bit of a discrepancy there. So we've talked about this notion of income inequality, but the real big issue here is wealth inequality. The notion that if you're above a certain level of wealth, your wealth can accelerate even higher without having to do anything because wealth can compound a lot more efficiently, especially if it's taxed at almost nothing.
yeah,
And the way to kind of think about this is, there's this notion of like a thermal nuclear reaction, and you pass this kind of tipping point where you have this kind of like nuclear core that it generates some heat and it gets the reactor going, and that reactor generates more heat which gets it going even faster, and it just keeps getting hotter and hotter and hotter, and there's nothing you can do about it. That's a concern, right? If you're not pulling that heat away, that's where these kind of nuclear disasters come into play. Too much heat is generated because it's a runaway reaction. And that's what happens here with wealth. If there's no way to kind of pull any reins in, it'll just kind of grow on its own without any effort because it can just compound, earning the simple market return by just getting an extra 7% a year after year, or so on. Even if you have, big drawdowns, it's not really taxed according to our system because until those gains are realized, that's when they're taxed. But if you're never realizing those gains, that's the strategy in play here. Then you just defer those taxes until after you die, and even then some. So the notion is, yeah, if you look at the tax rate based upon the growth in income, or sorry, the growth in wealth, then focusing on taxing income at a higher percentage is kind of meaningless. Meaning all the stuff we've been talking about, increasing the tax rate from like 35% to 39%, increasing a deduction here and there and changing it back to a Roth, it's not going to make any difference here. Something we noted, for example, is, back to that, what I mentioned with Warren Buffett in the 2014 to the 2018 period, he reported 125 million in taxes, but his wealth grew by $24 billion. He paid 23 million in taxes on the 125. So that sounds like a pretty high percent. 23 million on 125 is like an 18% tax rate. Again, still lower than his secretary. He keeps saying that. Nobody believes him, but these are the numbers from the IRS. But that's missing the point entirely. It doesn't matter even if he paid 100% income tax rate, meaning we just took all the numbers we've said in this Biden tax plan and just made them absurd. 125 million on the amount of growth in his wealth is still a fraction of a fraction. So at the end of the day, if there's nothing really in place in this plan to tackle, these issues of wealth inequality, which frankly we haven't talked about any yet. There's one potential, but I'll talk about it in a few minutes. But so far, none of the things we mentioned will combat this concern. By the way, if I didn't miss a zero, 125 million on 24 billion is about 0.5%. So even if he paid 100% in taxes on his income that he declared, he would still only pay 0.5% in income per dollar generated in wealth, whereas the average American will have to pay above $1, above 100%.
Yeah. So I think this almost goes back to like the philosophical conversation. It does feel, other than the step up in basis, which I guess is kind of the income tax on wealth in your lifetime, sort of. It does feel like they are trying to address some of the generational wealth and estate taxes going from one generation to the next. And so I'm a little curious, like, do you feel, would that be a good target? Or is it only be limited because it takes decades to come to fruition?
It might not be a bad target, but frankly, there are ways to kind of get around that, right? With the private foundations and things like that. You just take all your money, you donate it, and give your kids lifetime jobs on the foundation, on the committee, and they get to use the corporate jets to take all of their fancy trips and whatnot. So I don't know, does it really change much by putting in more legislation to target the estate tax? Hard to say. If I think what we've reviewed so far in the Biden's tax plan, not really going to make that big of a difference. However, there is one proposal that's out there. Who knows if it'll make it, past tomorrow? But the notion is you could tax unrealized gains, and instead of letting them grow for decades without ever being taxed, that's potentially one way that you might be able to combat this issue. And frankly, if we don't want to make it too complicated for everyone, we just have it attached to, like we said, the 400 richest Americans, and you could probably accomplish 99% of your objective. But yeah, the notion there is a large part of why wealth can grow indefinitely or exponentially with a low tax rate is because the wealthy get to defer their gains. They don't have to realize it because they don't need that wealth to live, or they don't need the vast majority of that wealth to live really well. It's just not necessary. So you can just let the bets ride indefinitely, or you can borrow against that. We've heard, there's many strategies to not ever realize wealth. So yeah, well, one notion would be that each year you would take your growth in wealth, your unrealized gains, and you would pay a tax on that. If you're super wealthy, you got to figure out how to do it. That's kind of how it would work.
So I'm trying, like, if I'm a billionaire, let's say I have a few $1 billion, and this is just my personality. Like, I own a sports team, so it generates revenue, but it's been appreciating. You know what? Jerry Jones has owned the Cowboys for a long time. Also owns the stadium that they play in, and so a large amount of his wealth is tied up in these two illiquid assets. Now again, like you said before, if there's a will, there's a way. We can like he can figure out the mechanics, but like, what would you suggest as a tax rate on unrealized wealth gains, even with a good like a, a fair market value? Like that's also a slightly separate conversation, but that's difficult to determine. But if we had a good fair market value, what do you think would be a fair rate on unrealized gains?
Right. I can just guess and speculate here, but maybe a good rate place to start is, like a percentage of whatever the rate is on realized gains, call it 80%. I'm making stuff up.
Okay.
And yeah, but let's just start the conversation with something like that. Sure.
So maybe it's something like, I could actually see like something like, if you don't realize it, there's a 0.5%, or half of the regular realized gain number. But if you realize the gain, then it's the full amount.
Yeah,
So
you get some
I like that
benefit
idea of
for not
tying it to,
realizing.
yeah, yeah. So you're paying something, but it like realizing it is not as costly compared to the alternative kind of thing.
Right.
So I like the idea of like tying that unrealized gain number to the realized gain number and creating some incentive to realize more of it sometimes. But so next, I'm like, if yeah, because it's like those mechanics of like, okay, if it's the stadium's worth $1 billion, I think the stadium's worth like 5 billion, and the team's worth another 5 billion. But it's I guess it's gone up each year, so it's not doing all that at once. We're doing on the gain of the asset, so it has to go from 5 billion to 6 billion, and he would pay 200 million in unrealized gain taxes, which that might be within the realm of like, he probably has the cash flow to figure that out.
Yeah, in my mind, if we're talking, the tens of billionaires and above, 10 billion and above, and you're holding assets that cost billions, there's a market for assets that cost billions. There may not be an asset for, or a market for an asset like a farm that costs like 10, 20 million, or maybe hard, but you can market things, that
Yeah.
are billions of dollars. There's people who will buy it.
Yeah, you could
You
also
don't need
probably
to
like
sell it all. You can sell a percentage.
yeah, that's what I was saying.
These
You
are
probably keep
choices.
It'd probably be some incentive to kind of sell minority ownerships, to sell 1 or 2% per year. So that's actually, yeah, if you sold uh if you owe $250 million in unrealized gain taxes, and you took your $5 billion asset and sold 1%, you're at $50 million. So might encourage you to sell a few percent per year in addition to just whatever your investment, like your income generated from that investment is.
Right. Yeah. And again, you have $10 billion. Pay someone to figure it out.
Yeah,
They'll figure it out for you. Don't worry.
that's kind of the issue. Like, they're already doing that a lot. to
Yeah.
to
You just add more billable hours,
yeah.
and you'll be okay.
Anything else that you can think of as you're reading through this?
Well, I think that's kind of the main point. There's a lot in here, to combat or to make some impression that income inequality is a thing, and there's some things that can be done about it. But frankly, I'm a little skeptical that much will make it to the table to combat wealth inequality.
Yeah. It's for most people, like, again, the child tax credit for median household incomes, that's nice, but everything else is those high income earners, not necessarily wealthy.
Yeah, there are a few benefits, like you mentioned, and I think it was even debated at one point. Should they put in, they want to expand public programs like, Medicare to include dental, hearing, and vision. They want to provide or do something to reduce prescription drug prices. So there's certainly things that might help, clean energy and other programs like that. Again, the skeptic in me says that it's going to be a struggle for some of those policies. For example, to get lower drug prices, there's no powerful grassroots group devoted to lowering drug prices, but there is big pharma trying to combat the increase. So, the concern here, as we all probably know, is this is a very tight legislative agenda because there's barely enough votes, probably down to 1 or 2 votes to get this to pass. So you don't got to buy out every politician in the country to make this whole thing fall apart. And so it's
you
one of those
only need
things
to
where,
buy out 2 or 3.
right. And yeah, big pharma knows that, and so do the politicians.
Yeah.
And the same thing for increasing taxes on the wealthy and corporations. Tax rates are at their lowest levels for the affluent. We've said that many times. And there are groups representing the interests of the wealthy, especially former Congress members. So,
Yeah.
there's lobbyists out there. And again, some of these are former members of our Congress trying to persuade the Democrats to water down the legislation, especially when it relates to some of these tax increases. And they might have a lot of sway to buy that one vote. So,
yeah,
there's some skeptic, or the skeptic in me here says that even the versions that we've talked about today, it's going to be a tough battle.
Yeah. I think that's kind of like, there's a lot of stuff in here, a lot of like detailed changes that kind of some of my clients will go through, especially for my clients who have like that one-time liquidity event where, okay, their incomes are below the 450 combined household income, except for the 1 year where they are selling $1 million in stock, and then it goes back down below. Like this does create some planning issues there, but big picture, like, yeah, I don't know. Like I said, it's going to keep CPAs and tax attorneys employed for a long time.
Right. Yeah. And it's something we mentioned the last time. It's hard to say that you can proactively make any major changes based upon what we know now. It's just too many what ifs and contingencies in play.
Yeah.
And frankly, if the mega backdoor Roth goes away and the standard backdoor Roth goes away, that's something that you probably want to take advantage for the next year or two, but that's kind of it. Then you got to do something else.
So I'm curious to hear from our listeners of, like, is there some part of this that they've heard that's going to affect them that they're concerned about? Do they like the kind of targeting incomes over that 400? Does that feel like it's progress? Does it feel like are you just as skeptical as Trishul? It's like there's a lot of noise that's not going to actually do anything. So I'd love to hear from listeners on some of their takes on the Biden tax plan.
Great. Yeah, we'd love to hear from you. And thanks, Aaron. I enjoyed the conversation. If you're enjoying these conversations, do spread the word. Thanks.
Thanks. Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.